two people, same age, same salary. One retires with $1.4 million. The other wonders where all the years went. The difference wasn't luck, wasn't a bigger paycheck. It was one decision, made once, automated, and left alone for 30 years. That decision was investing $1,000 a month into an ETF. And today I'm going to show you exactly how it works, what the numbers actually look like, and the step-by-step plan to start, even if you've never invested a single dollar before. Stay with me, because around the 2-minute mark, the math gets genuinely hard to ignore. Here's why most people never start. They think investing is for people who already have money, or people who understand the stock market, or people whose lives are finally stable enough to take the risk. So they wait, month after month, year after year. And the waiting, as innocent as it feels, is quietly one of the most expensive financial habits a person can have. Because in investing, time is the only resource you cannot earn back. And every month you delay is a month of compound growth that simply disappears. So what is an ETF? Simple version, it's a basket, one investment that holds hundreds of companies inside it. When you buy into an S&P 500 ETF, you're not betting on one company succeeding. You're spreading across 500 of the largest companies in the world, Apple, Microsoft, Amazon, in a single move. Diversified, low cost, and historically, over long periods, it grows. Now the numbers. $1,000 a month, 8% average annual return, roughly what the S&P 500 has historically delivered. Here's what happens. After 10 years, you've invested $120,000. Your portfolio, around $185,000. After 20 years, you've invested $240,000. Your portfolio, nearly $590,000. After 30 years, you've invested $360,000. Your portfolio, approximately $1.4 million. That extra million didn't come from working harder. It came from compound interest, your returns generating their own returns month after month, decade after decade, while you lived your life. Now here's the part that actually separates people who reach that number from people who almost do. Because the math is easy to understand. Living through a 30% market drop while your portfolio is bleeding on screen, that's something else entirely. There's a psychological concept called loss aversion. The pain of losing money feels about twice as intense as the pleasure of gaining it. So when your portfolio drops $15,000 during a market correction, every instinct tells you to pull out, wait, protect what you have left. That instinct, acted on, is what destroys long-term returns. The strategy that works against it is called dollar-cost averaging. Same amount every single month, regardless of whether markets are up or down. When prices drop, your $1,000 buys more shares. When prices rise, it buys fewer. Over time, you average out and you stop trying to time a market nobody can predict. Pair that with automation, setting your transfer to go out the day your salary arrives before you touch anything else, and you've removed willpower from the equation entirely. You make the decision once, then it just runs. Here's the actual plan. First, build a 3 to 6 month emergency fund before you invest aggressively. Without it, the first crisis forces you to sell investments at the worst possible time. Second, use a tax-advantaged account, a Roth IRA, ISA, or 401k depending on where you live. 1 hour of research here compounds for decades. Third, choose a low-cost, broad market ETF, something tracking the S&P 500 or total market with fees below 0.2%. Fund fees quietly eat your returns over time. Keep them minimal. Fourth, start with what's honest, not what sounds impressive. $200 a month beats $0 a month every single time. Increase it as your income grows. Fifth, let it be boring. Ignore the noise. The flashy strategies come and go. The consistent low-cost index fund strategy keeps compounding in the background. Before I close, one honest thing. If you've had this plan sitting in the back of your mind for months and keep waiting for the right moment, I want you to know that moment doesn't arrive on its own. The people the math works for are the ones who started imperfectly, with whatever they had when life wasn't perfectly ready either. This isn't really about becoming a millionaire. The number is just a side effect. It's about buying yourself options, the freedom to leave a job that's draining you, the ability to say yes when someone you love needs help, the peace of mind of knowing the future you is being taken care of, quietly, automatically, every single month. Start simple, start honest, start now. Because progress, done consistently and without drama for years, beats perfection every single time. See you in the next one.